what do you see as your biggest priority at the moment going forward into your new financial year?
There is absolutely no doubt in my mind that the controllable side of our business, we have to continue and pursue those. And that is looking at our cash, focusing on safety, the imperative of safety, looking at our costs, looking at our volumes, growing where appropriate, sweating the asset where appropriate, curtailing where appropriate. I think you understand that dynamic. But then capital expenditure and working capital holistically are a component which makes you strong and allows you to position yourself into the future. But key to and overriding all of this, the operations must be profitable. We cannot continue funding loss-making operations. And the price we've got is the price we must work to and survive that and restructure accordingly.
And African Rainbow Minerals is also in coal, and it's also in platinum, and it was in chrome to some extent. What do you see the commodity areas having the most promise at the moment?
All commodities will have a use into the future. What drives us is not about the commodity mix and the diversification. It's more, does that operation within the commodity you're mining, can you make good margins? That's the key driver. It doesn't mean that this copper in Zambia, with the challenges it's had and continues to have, and what we've discussed, means that we are now running away from copper. We remain committed to the iron ore, to the manganese. We like what we've got in platinum. Based on what we're seeing now, I think getting more of platinum and building up that critical mass, providing that operations on the right side of the cost curve is mechanized, lends itself to mechanization. It's not just acquiring a commodity because I like the commodity. It's a commodity we want to acquire because we can make good money.
What are your plans to actually modernize your manganese business and bring it into a situation where it can really contribute?
Manganese has been a key priority us for a long time. The manganese operations in the Northern Cape have been running for many years. It has aging shaft infrastructure, it has logistical constraints and ore handling constraints. Premised on that, we've noticed over the last couple of years the unacceptable cost increase based on productivity that's declining and waning, and we were very clear that if we wanted to be well positioned into the future, we had to do something about this. This coupled with the fact that there is a dynamic in terms of supply, that operation has high grade and low grade material. And we see that with emerging players mining a lot of low-grade material and flooding the market, we've seen the volatility in prices. We were very clear that we also need to exploit the higher grade seam on the Chwaneng ore bodies, and overlaying the existing seam 1, we also want to exploit the overlying number 2 seam, which is also a high grade. But it needs that whole infrastructure upgrade. That coupled with Transnet, who rightfully so want to load and get the loading and logistics. They want that down where it historically could take anything up to 20 hours to load a rake, which is a train of ore, to get that down to a reasonable time. And so that modernization and of that and the manless articulated precision loading is also part of the requirements that Transnet needs. And as you're aware, they're ramping up capacity into the port of Ngura, and the person or the mine or the operations that can supply the product, the best spec at the best quality at the highest rate will benefit from that. A combination of all these and the fact that we see there's a world short supply of high-grade manganese. This drove our initiation of this project. The project was 6.7 billion. In addition to that, it ramps up from an existing 3 million tons per annum up to in excess of 4 million tons if the market requires. But it also allows you the flexibility between taking high or low or mix. It has all the benefits of the equipment utilization. It has the benefits, as I said, of the surface infrastructure. So it's a project which will also significantly lower our costs and keep us competitive into the future.
On the alloy side, we know that it's quite difficult to operate in South Africa at the moment from the high cost of electricity point of view, and you have invested in Malaysia. Can you update us on the Sakura project?
The first phase has been executed. It's in ramp up. It's the second, that's the first furnace. The second furnace will be ramped up, in fact being commissioned as we stand, and by the end of this financial year we will have both of those furnaces running at full capacity.
And on the copper front, the entry into Zambia with the Lubambi has been particularly challenging.
We kick-started that operation back in 2010, but subsequently prices have come up quite substantially. That operation can't compete on this price range, so we've had to get in there and do a significant amount of restructuring. So the ramp up in the first place was curtailed because it's no good producing more metal at a loss in a market that's in oversupply for now. And so our options were then, in terms of restructuring, is to reduce the overall tonnage, cut back on the capital component, look at the way we exploit and extract the ore body in different methods which are more cost effective. And this then lent the opportunity with the lower plant reductions that we could optimize the plant and in fact get a finer mill through it. And we see that in the last couple of months, even the recoveries have moved up from the historic and planned 81%, currently around the 86%. So a lot of initiatives have gone in to get this operation cash neutral or bring its cost position down. However, the prices remain depressed. The current forecast or outlook for the next 2 to 3 years is a very low price. So we have collectively, that's ARM and its partners, have got a team looking at all of our options. And there are a number of options. Whether that means simply restructuring, reducing production further, maybe taking the stake over of one of the partners, or maybe recapitalizing the project or getting someone else in. And one of the options would be a joint exit. And so all of these are being evaluated and addressed right as we stand. And we will do what we believe is the best interest of the shareholders and value creation. I have no doubt, Martin, that it is purely a timing issue. That an ore body like this in the right hands, as an integrated person that's smelting and refining and marketing, the arbitrage, it could be a very good opportunity for someone in a low price environment, which, you know, in our case we may have to consider waiting a couple of years.
It was Creamer Media's Mining Weekly Online talking to Mike Schmidt, the CEO of African Rainbow Minerals.